Okay, good afternoon, everybody. Thank you so much for joining us. First off, before we get started, just a couple housekeeping items. There is that chat bar button on the bottom right-hand corner. If you guys do have questions along the way, please don't hesitate to do that. I do apologize for any technical difficulties that we may or may not face. Under the COVID-19 rulings, we're all working remotely here. Thankfully, we have technology to help us out with this stuff, so we do appreciate your patience along the way. So just a little bit of a brief introduction. So my name is Shiraz Ahmed. I am a financial advisor and portfolio manager with Sartorial Wealth of Raymond James. What's a bit unique about myself and why Zoe asked us to help facilitate this webinar today is that I'm actually a cross-border licensed wealth manager, which means I'm actually licensed to advise on financial matters in both Canada and the United States. So for that reason, we can frankly do some things that a lot of the other institutions cannot. So that being said, why is this such a big deal, and why are we going to talk a little bit about tax? So as we all know, as a domestic Canadian or as a domestic American, taxes can be complicated for a regular person. If you add on top the fact that you're now a cross-border individual and you have one foot in each country, that unfortunately compounds the problem, and it becomes significantly more complex than just an average regular person's filing. There are some do's and don'ts that go along the way. So part of the plan today was, and in conversation with Zoe and for you guys as the members, this is ultimately for you as a value add. We have Kylie Bechtold from MAC LLP as a cross-border tax specialist here to talk to you a little bit about some of the ins and outs. Again, this is a very unique scenario, given that not everybody has this cross-border side, wherein you have either money or family on both sides of the border. So that being said, the concept behind today is just to go out and do that. If you have questions, I would encourage you guys to ask. If there's specifics about your personal situation, I would maybe suggest taking that offline. We'll definitely share our contact information at the end. And then if you have any specific questions, we're happy to address. So without further ado, I'm going to pass it over to Kylie, who can then start talking a little bit about the tax side of things. So Kylie, over to you.
So there's a lot going on right now in the tax regime. There's a lot of unknowns with the pandemic going on right now. Today, we're going to sort of outline, I have a lot of material in here, but we're going to go through these slides rather quickly. Some of these slides will be more for reference for you in the future, just depending on your scenario, just because I know the audience each of you are probably in different situations, but I just wanted you to have all the information available. So we're going to start today just discussing the U.S.-Canadian Income Tax Treaty. This is basically the bread and butter of cross-border taxes when we're dealing with Canada and the U.S. So we have once we get through the treaty, we'll discuss Canadian residency versus U.S. residency and how those affect you as a taxpayer. We'll discuss Canadian residents working in the U.S., as well as Canadian citizens living in the U.S. We'll discuss U.S. citizenship and what that means, as well as if you have a green card, how that affects you. And then, like Shiraz said, we'll have lots of time at the end for questions. So to start off, I sort of wanted just to lay out the U.S.-Canadian Income Tax Treaty. So this was created back in the 1980s, basically to eliminate double taxation. So we have U.S. tax laws, we have Canadian tax laws, and then where it intersects, we have the treaty. So when we're doing cross-border taxes, when it comes down to a situation where maybe the U.S. is saying one thing, Canadian tax law is saying another thing, we refer to the treaty. And the treaty basically does trump U.S. tax and Canadian tax law. So the main thing, the reason the treaty was set up was to eliminate double taxation. Now the U.S. has tax treaties with various countries. You can go on the IRS website and they will list all the treaties that they have. The U.S.-Canadian Income Tax Treaty can be found on CRA's website as well as the U.S. website. The treaty, it covers in different articles basically reduced withholding for Canadian and U.S. citizens and residents. Certain provisions for Social Security, CPP, and OAS, certain provisions for self-employment taxes. Then they discuss a credit that's available, a foreign tax credit, which some of you might be familiar with if you are, for a lot of US citizens living in Canada, this would be something that they'd be filing with their 1040 every year. As well, there's a foreign income exclusion available, which I'll explain just shortly. And then in the treaty, it also talks about death and estate taxes, because this is something that we address with the US. One thing it does not cover is gift taxes. So this is not covered under the treaty. So these rules would not have any protection under the treaty. So just a quick recap, just because I know we're dealing with a bunch of audience and not sure where all you are at, what you're aware of. So basically for a US citizen living in Canada, you're able under the treaty to exclude up to $105,900 in 2019. That's indexed for inflation every year. So that income is earned income. So it would have to be income on a W-2 or T4. This is designed more for moderate to low income taxpayers, relatively easy tax situation. They don't have a lot going on. And we don't use this as much for a lot of our clients. What you'd see more, and I think you'd probably see a lot more on your tax returns, is the foreign tax credit. So what the foreign tax credit is, it's filed on Form 1116, and this would be attached to your tax return every year. And it allows you to take a credit for any foreign taxes paid to offset your US taxes. For many of you Canadian individuals, I'm sure you're very well aware that Canadian taxes are very much higher than US taxes. So the benefit of the foreign tax credit is that you're able to carry over any of that excess that you don't use. You can carry it back a year and forward 10 years. So it's a tax planning benefit, where the foreign income exclusion, that tax is lost. The foreign tax credit, you're able to carry forward or back. A question we get from a lot of clients is, what if both countries want to tax my income? Unfortunately, you as the taxpayer do not get to choose how you want this taxed. Basically, it is taxed where it resides. So for example, and you'd see this quite commonly if you hold stocks, if you had Microsoft, which is a US company, and you lived in Canada, there'd be withholding tax of 15% on that dividend, because that's the IRS taking their share of the income for taxes. Now, on your Canadian tax return, you would claim this 15% as a foreign tax credit. So it would basically reduce your Canadian tax by that foreign tax credit. The example here on the screen is if you were at the 40% bracket in Canada and you paid 15% to the IRS for that dividend, the remainder of the 25% would be paid to Canada. So now we're going to switch gears a little bit. I sort of introduced the treaty. We're now going to talk about residency. And I think this is probably has affected a lot of you as individuals. We're going to talk about US residency, what's considered a US resident and implications of that, as well as Canadian residency. So first we're going to discuss Canadian residency. Now, Canadian residency isn't very clear cut. There's not one question you have to answer and you're considered a non-resident. It's very much a question of fact. A lot of times we explain it to our clients that it's sort of like an octopus, and where more of the tentacles touch is where you'd reside. Now, if you go to the CRI website, they outline different ties that would tie you to Canada, and some ties are weighted more than others. For example, the main ties they're looking at is, where's your home, where's your wife or husband, your spouse, partner, and where are your kids. Those are the main ones, and those, if they are in not the country you're residing in, is where they would question it, and we would see more question. Now, secondary factors to that would be things such as where your bank accounts are, where your memberships are, where your driver's license are. But the main thing they're looking at is your family and your house. Now, for Canadian tax purposes, we tax based on residency. So like most countries in the world, we tax if you live in Canada and you're a resident in Canada, you're taxed on your worldwide income. Citizenship is irrelevant. So for example, my husband is a US citizen living in Canada. He is not a Canadian citizen. He's a permanent resident of Canada, but not a Canadian citizen. He's taxed in Canada on his worldwide income. If for myself, when I lived in the US as a Canadian citizen, I was no longer taxed in Canada because I was no longer a resident of Canada. So it's based on residency, which is a different mindset than the US mindset. Now, since we're based on residency, to actively cease residency, you have to make that action. So you would have to file a tax return in Canada, ceasing residency. And now I'm going to get into that a little bit. For clients, a lot of times when they're considering ceasing residency or they're unsure whether or not they would be considered residents of Canada, we refer them a lot to this survey provided by CRA. It's called the NR 73. And sometimes when you actually cease residency, we've had clients, it's been mailed to them to fill out to provide them. So I've pulled it up here. This is just sort of the outline, but I have it pulled up over here. And you can see it sort of outlines basic information, your name, general information, why you're leaving Canada, what kind of relations you have, where you're working, and then down here, your ties to Canada. So basically going through those primary and secondary ties that we were referring to in the slides above. Now, this isn't something, I have had clients that when it comes to residency, they've argued, they might have had some things that maybe their house was still in Canada, or maybe one of these primary ties were still in the other country, but they had other ties that still proved that they would be a non-resident of Canada. And a lot of times that will be I haven't had issues with that, but it's something that usually you want to have it quite clear cut, because what could happen is if you were to cease residency in Canada, for example, moving to the US and ceasing residency in Canada, and Canada found that you still had ties and you were still considered a resident of Canada, they would come back to those years you were not a resident and assess taxes. So it needs to be, you need to have it pretty clear cut when you're taking that position. So when you cease residency of Canada, like I said, you have to actively cease residency. So you have to file a final T1, which for those of you who maybe aren't aware, it's like your 1040 in the US. And you have to basically, you're letting Canada know that you're no longer being a resident of Canada. So for example, if tomorrow I was to cease residency, I would be considered a resident of the US or a resident of Canada from January 1st to March 17th. And I'd be filing on my worldwide income. From that day forward, I would only be filing and paying taxes to Canada on Canadian taxed income or Canadian earned income, like if I was to get a T4. But for the most part, you're only taxed on your worldwide income up until the day you cease residency. Now, with that, Canada also has, so we have a deemed disposition on that date you cease residency. So similarly, when you die in Canada, we don't have an estate tax regime. You're basically deemed of disposing everything at its fair market value at that point in time. We sometimes say it's like an auction sale. So similarly, when you cease residency, you're deemed of disposing all your assets at that point in time. Where this will affect clients is if they have like an unregistered brokerage account, for example, with large gains sitting on it, unrealized gains. This could potentially lead to large taxes due in Canada. So usually if this is something you're considering, you need to really talk to your tax practitioner in order to basically do some tax planning to make sure that when you cease residency, it's not going to create a large taxable event at that point in time. In addition to filing this T1, you attach to it what we call a T1161. That form is informational. You're disclosing all of your assets. Now, this isn't required if your assets are under $25,000, but if they're above, then this is required. There are penalties if this form is not filed. It's like you can see here, it's $25 a day. maximum of $2,500. Things that aren't included on this form are your cash accounts, pensions, RIFs, 401ks, RESPs, Canadian real property. Canadian real property, this is taxed differently. If you were to cease residency and still hold Canadian real property, later on when you go to sell that, then you'd be taxed on it later on. This is sort of out of the scope, that's sort of out of the scope for today, but there is different tax implications when you sell Canadian property as a non-resident. As well, any personal property under $10,000, you would not be required to disclose. So now that we've sort of talked about Canadian residency, we're going to switch gears to how US, what's considered US residency. So like I referred to earlier, US citizens are taxed based on citizenship. So Canadian, it's residency, US is citizenship. The US is one of only one other, there's 2 countries in the world that tax on citizenship. One country is a small country in Africa, and the US is the other one. This has been something that's put on the table every election to try to reevaluate this because it's hurting and affects so many taxpayers, US taxpayers abroad. But currently, you're taxed based on citizenship. So if you don't live in Canada, it doesn't matter where you live, or if you don't live in the US, it doesn't matter where you live, you're always taxed as a US citizen. You're subject to income taxes, social security taxes, gift and estate taxes, and excise taxes. So what classifies as a US citizen? So when we get into these talks about citizenship, usually if a client comes to me and has questions on it, most of the time we're referring them to an immigration lawyer. The reason being, immigration laws changed quite a bit over the past 50 years. And depending on the year that you were born, depending on the year that you came over, the rules could be different. So typically, if it's a complicated situation, we're referring them to an immigration lawyer. Pretty black and white would be if you're born in the US, if you have a birth certificate in the US, and from your parents, you could be US citizen. Now, one thing I have starred down here, which I'm going to talk about a little bit later, is how green card holders are treated as citizens for tax purposes. So this is something that would affect a lot of Canadian individuals that go down there and get a green card for work purposes. So they start on a work visa, then they get a green card. If you were to move back to Canada, even though you no longer are living in the US, if you have that green card, you still have to file a tax return every year. So that's something to be mindful of, and we'll discuss it a little bit later on as well. So for children, a lot of clients come to me and say, are my children US citizens? Sometimes they want their children to be US citizens so they can get the child tax refund. Really, the main thing is if your children be US citizens if they were born in the US while you lived in the US, as well if you as a parent lived in the US for at least 5 years prior to coming to Canada, and 2 of those years were before the age of 14, then your kids would be accidental Americans. Again, usually if it's a question, we're sending you to an immigration lawyer because the laws have changed year to year. Other reasons that your kids could be, if you were present in the US for at least a year prior to their birth, they could get citizenship, as well as you don't know who your parents are, but you reside in the US, you could be a US citizen. The US also has a substantial presence test. So it's basically, a lot of people hear this 183 rule. So if you were in the US for over 183 days over the past 3 years, based on this test, then you would be considered a resident of the US. Now this test isn't 183 add up, that's how you get to meet the physical presence test. It is 100% of the current year. So in 2019, for example, it'd be all your days in 2019. In 2018, it'd be a third of those days. And 2017, it'd be a sixth. So in this example here, you can see that this individual, for example, went to the US for 140 days in 2019, so we'd use all those days. 120 and 18, we'd only use a third of those, so 40, and 60 days in 2017, so we'd only use 10 of those days. So we're looking at a total of 190 days. So he failed the physical presence test, and judging by this, then he'd be considered a US resident. Now, there are treaty rules and disclosures that you can do to get around this. You're probably thinking like your parents or who go down to Florida every year, like if snowbirds, for example, they would easily get over this 183-day mark. They're able to file what we call a closer connection statement. And basically, this is filed with the IRS. You don't have to file a tax return. It goes separately to the IRS every year. And you're telling them that I'm Canadian, I've been here over 183 days, but my closer connections are with Canada. So my driver's license is in Canada, my belongings are in Canada, my healthcare is in Canada. All my ties are to Canada. It's sort of getting back to those ties that we're talking about, that you still reside in Canada. Now, there's certain U.S. income for Canadian residents that are subject to withholding tax, but you don't have to file a U.S. tax return. So if you're a Canadian resident and you get dividends, like the example we were saying before from Microsoft, you don't have to file a tax return for that. They will automatically withhold 15%. Down the road, for those who worked in the U.S. and then moved back to Canada, when you get those 401k pensions or IRAs, as long as the brokerage or the person holding it knows, sometimes they'll ask you to fill out a form and withhold the proper amount of tax of 15%, then no tax return is required. In this example, though, I will see sometimes that a client that gets a 401k or an IRA, for example, they will automatically withhold 30%. So they've over withheld. So in that case, you'd want to file a US tax return to recoup that additional 15%. Because under the US Canadian Income Tax Treaty, and like I said, that trumps all, CRA will disallow a 30% credit on that. They will only allow 15%. Gambling winnings, that's another one we see, especially if you're by Vegas or up here in Waterloo, Niagara Falls. There's a 30% withholding on those and no tax return is required. Now, tax returns are required if you were to get a Canadian resident and you get a W-2 for over $10,000, or if you had a rental property in the US, if you sold a property in the US, if you were self-employed and you had an establishment in the US, an office in the US, and you were working there for 183 days, that would be taxable in the US. Partnership income. So for example, if you're a Canadian resident and you hold an interest in a partnership, a US partnership or an LLC, you would be taxable in the US on this. Now, again, a little out of scope, but when we get to US partnerships, if they have foreign partners, they will withhold that income and pay it to the IRS on your behalf. So then you file a tax return to claim that remittance. Certain income for Canadian residents would not be subject to US tax. So if, for example, and it would be vice versa. So if you're a US citizen and you have a Canadian bank, you're getting interest, there would be no withholding on that. That is only taxed where you live. For example, capital gains is another thing. It only is taxed where you live. So for a Canadian individual a Canadian resident has a US trading account, those gains will only be taxed in Canada. Or a US resident with a Canadian trade account, but same thing, it'll only be taxed in the US. So capital gains are only taxed where you live. Investment income that would be exempt for US citizens would also be exempt for Canadian. So now we're gonna switch gears a little bit to employment income. So those of you who receive a W-2, and I think this would probably affect a lot of our taxpayer abroads. So I'm going to go through sort of three different scenarios. So the first would be if you are a Canadian resident living in the US and receiving a W-2. If you are, a Canadian citizen. If you're a Canadian resident commuting and working for a US company, but maintaining residency in Canada, or you're a Canadian resident that's working remotely but receiving a W-2. So if you were working from your home office for a US employer, how those would be taxed. So the key in all these scenarios is where the service is performed. So for example, if you're a Canadian resident and you're working from your home office for a US company, then that income is taxed in Canada first. Canada gets the benefit to tax that. If you were living a Canadian citizen or citizen living in the US, receiving a W-2, you'd be taxed on that income in the US. If you were a Canadian resident commuting, if you were going down there just for the week, you'd be taxable on that in the US. So there's a lot, when we get to cross-border, there's a lot of analogy figuring out where that income is sourced. And to be honest, a lot of times HR doesn't always get it right. So the withholding might not always be correct, judging, because they're just basically judging on the US. So a lot of times they'll do all the US withholding, even though it might be technically Canada that has the first right to tax that. So again, when we're getting into situations like this, we need to be consulting with our tax practitioner. This point under here was just saying that Canadian residents, like if you were a Canadian resident, you got a W-2 under 10,000, you wouldn't have to file a US tax return. So here I was sort of saying again, like depending on the scenario, you'd have different tax filing obligations. So if you were a Canadian citizen who moved down to the US, you ceased residency in Canada, you would no longer file a Canadian tax return. You just file a US tax return and report that income on your US tax return. Now, if you were a Canadian citizen or resident, you maintain your residency in Canada and you're commuting and going down there, or you're just traveling down there for work, you would file a non-resident tax return. So you'd only be taxed in the US on that W-2 income. You would include a treaty disclosure, and under the treaty, you're only taxed on your worldwide income where you live. And so, excuse me, sometimes you'd have an exemption for withholding on compensation. That we don't see very often. Usually for a commuter or someone who's going down, for example, here in Waterloo, we have a lot of the tech industry. So I have a lot of clients that are working down there in Apple, Facebook, but their family is still up here. So they're maintaining residency in Canada, filing a non-resident return in federally. Now, California does not follow the US-Canadian income tax treaty. Not all states follow it. So then we're going back to physical presence. So potentially you could be a non-resident federally, but a resident for California purposes. This I sort of referred to previously. There is a potential for mismatch of withholding. So depending on where the income is sourced, it might not always be withheld correctly on your W-2. So there could be a scenario where you're getting a large refund on one side, one country, and owing tax on the other country. I do see that quite often. Again, there's potential state and city filings. Like I was saying, not every state follows the US-Canadian income tax treaty. So you might be exempt federally, but you would have to pay city and state taxes. Potential higher total taxes than in Canada. Sometimes we'll see, like depending on the state, you might owe taxes in Canada, where on another state you might not owe taxes in Canada, like depending on what the state tax plus the federal rate is. Typically Canadian tax rates are higher, but for example in California, usually they're almost par. One thing that needs to be remembered, and I see this a lot, is as someone working in the US, a lot of times clients will email me and ask me questions about whether or not they should contribute to their 401k, especially if potentially they're considering moving back to the US eventually, or to Canada eventually, and they're like, well, I don't know if I want to keep this money down there. Usually I'm encouraging clients, if there's a match, then it's worth it to contribute. For Canadian tax purposes, if you're maintaining your residency in Canada, you do get a reduction, like it's similar to an RSP deduction on your T1 for that contribution. So you do get, there is benefit to that on the Canadian side. So I wouldn't shy away from that. It's definitely something that can be handled. And Shiraz can also say, like, if you are moving back to Canada, then you could potentially then move that 401k to Raymond James that they could then hold for you. So it's definitely something that I would, if you're given that offer, then I would encourage clients to take it up. So now for Canadian filing. So this is if you're maintaining your residency but getting a W-2. So you're working in the US but maintaining your residency in Canada. This income is reported as other income on your T1. So you have your T4 income, and the line under it is where you'd report that income. You'd get a foreign tax credit for federal taxes paid, state taxes paid, Social Security, and Medicare taxes. And these are things, the Medicare and Social Security, sometimes I see missed. Another thing to note is the federal taxes claimed as the credit and the state taxes are the taxes on the tax return. So not what's reflecting on the W-2. CRA audits these very frequently. So if you are maintaining residency, filing in this position, you need to ensure that it's reported correctly, that you maintain your W-2 and the tax returns, as well as they'll want the IRS transcript as proof. I would say probably 90% of foreign tax credits are audited by CRA. And we've seen that up a lot in the past few years. Like I said previously, you can get a deduction for your 401k contribution. This is filled out on form RC268. I don't expect you to remember these forms, but that's why we have this presentation that you can refer back to these. We'll see about getting it posted or having access to it as well. I'm gonna just skim over the self-employment because I don't think this will apply to a lot of the scenarios. So this would be if you're Canadian resident and you're going down and working in the US. Typically, self-employment income is only taxed where you live. So if you're going down, for example, we'll have a lot of consultants that are going down and doing work. They could be like an engineering consultant going down and doing different work in different states. They would be exempt federally from that income. It'd all be taxed in Canada, but nothing would be taxed federally in the US, as long as they don't have a permanent establishment, so an office in the US. We'd file a non-resident tax return with that and a treaty disclosure. This is an example of the 8833. So we'd have attached something similar like this to those who are maintaining residency in Canada. So if you were to go down and you're working and you're there over 183 days, but you're reside in Canada, we'd have to include a treaty disclosure basically stating that I'm a resident of Canada, therefore a non-resident of the US, and only taxed on my US source income in the US. So this is just an example for those who are in self-employed. This slide's just stating that if you have a permanent establishment, then you could be considered taxable in the US. So if you're going down and doing self-employed work in the US, the main thing is to ensure that you don't have an office down there. Now, I mentioned previously that there are states that don't accept the treaty. So California, like for a lot of you, this would be a state that you would be exempt federally, but taxed on the state side. New Jersey, Maryland, there's a list of them. Now, a lot do when you put it in perspective, but these are a lot of the states that a lot of business is done in. So this affects a lot of our clients. Of course, there's the states that don't have state tax, so you could be exempt federally and pay no federal tax, no state taxes. So in that scenario, if we had someone who was self-employed and did all their work in Florida, then they'd not owe any state taxes and not owe any federal taxes. So now we're going to touch on Canadian citizens living in the US. So these would be people that have previously ceased residency. So what the slides we talked about earlier of those who went through, filed their final T1, filed the 1161, had the deemed disposition. Now they're living in the US. They no longer have a filing requirement with Canada. They would just file 1040 as a resident going forward. Now, there are things to be aware of if you were a Canadian citizen living in the US, just because in Canada, there's certain things that are available that have taxable benefits that aren't the same in the US. So for example, a tax-free savings account. In the US, these are treated as foreign trusts. So if you were to hold a TFSA and you were a US resident, first of all, it's taxed, so it's not tax-free. As well, the US views these as a foreign trust, and there's additional trust filing reporting. So it's called a 3520. These 3520 forms are due March 15th and April 15th. So there's 2 forms that you have to file. The reason these are so burdensome is there are $10,000 penalties associated with each of them. They're strictly informational, and a lot of times they're more work than they actually, that's in the fund. So the income that's generated in it isn't really enough to benefit, to make it worthwhile to have to do these reportings. RESPs, that's another one. They are not tax-free in the US. Now, recent regulation, about a week and a half ago, it was released that these no longer require 3520 reporting. So previously, some of the TFSA, you'd have to do these 3520 forms for RESPs, but that was eliminated as of this year. As well, if you have an open investment account, and this is something that Shiraz could definitely help you with, is basically making sure that you have a PFIC-friendly portfolio, is what we call it. So PFIC, it stands for passive foreign investment companies. And these are companies that basically the majority of their income is usually made through passive income, and they're taxed differently than they are in Canada. We have additional reporting that we have to do for them. So for example, if I have a client that has an open investment account with 10 mutual funds, I will have to do 10 separate forms reporting the changes in these mutual funds, as well as I have to notify the IRS how I want these to be taxed. So there's different different ways these can be taxed. This almost warrants a whole presentation on its own, because there's so much that goes with this PFIC reporting. But the basic thing to remember for you is to making sure if you have an open portfolio in Canada still, that you don't have those Canadian mutual funds, Canadian REITs, or Canadian ETFs. Otherwise, it'll just have much more burdensome reporting for you on your US tax return. As well, if you maintain ownership in your Canadian corporation, not only will have complications on the Canadian side, but also on the US side. With the new Trump changes back in 2018, he is now taxing foreign corporations differently. So we have what we call this GILTI tax. And it's very punitive for small businesses. The idea of these changes was more to influence the big companies that have offshore companies in Ireland, like Apple, but they didn't think about how it affects small businesses. So this is just something that planning needs to be around before, either now if you have that, or before you decide to move to the US. Now, when we get to green cards, like I mentioned previously, Canadian citizens with green cards are taxed like US citizens. So therefore, you have, similar to US citizen reporting, you have your FBAR that you have to do every year. This is known as, I'm sure most of you are familiar with this, it's called FinCEN 114. It goes to the US Treasury every year. I'll be talking about it quite shortly. So you're subject to that reporting. You're subject to a tax return if you have a non-US corporation. So I'll be talking about that shortly. You're subject to a tax return if you have a member in a partnership or a non-US trust. Of course, you have US gift and estate taxes. So there's a lot more, when you're a green card holder, it encompasses a lot more than you at first glance. So the FBAR reporting, like I said before, I'm sure most of you are familiar. This is due, it either has to be e-filed or it can be done online. It goes directly to the US Treasury, so this is not with the IRS. It's an informational return. It reports all your foreign US accounts to the US Treasury. Anything that you have signing authority on. It would include bank accounts, investment accounts, retirement accounts. If you have a Canadian corporation, it would include those accounts if you have signing authority on them. Large penalties are associated with this. It's required for individuals whose the accumulated amount is over $10,000. So it affects a lot of individuals, especially if you have retirement accounts. The penalties, like I said, are quite punitive. There hasn't been many cases in Canada of those who've been caught. There was someone in Vancouver. He was charged with being willful, therefore the penalties were much higher. If it's considered unwillful, it's $10,000 per account. I actually have that on the next slide. So for willful, it's $100,000 or half the value of the account. I have a lot of clients come to me who are new and they weren't aware of this. They hadn't been filing this. They're losing sleep over it. Usually we're having the conversation that for the most part, the people that are being caught, they're looking for the big fish. The reason this is so risky though now is with this FATCA reporting, every foreign bank is required to report to the US Treasury every day all their US residents, or sorry, every year, all their US residents or citizens. So what's happening is they're getting the report from the banks, they're comparing to their FBAR reporting and seeing mismatches, and that's how these people are being caught. So it's just something that's being more mindful of that, and with the way that the reporting has gotten much stricter, it's definitely something you want to make sure you're ensuring that you do. Like I said, it's due April 15th with an automatic extension to October 15th. So every year you have to October 15th to file this. With a lot of our clients, we're filing this with the tax return, but some clients prefer to do this on their own, and it's not very difficult if you have a rather easy, not many investments, but it can get quite complicated because a lot of information has to be reported. On it, you're reporting the name of the account number, address, and the maximum value of the account. So 5471s, this requirement is for US citizens, US residents who have ownership of a foreign corporation of more than 10%. So depending on that ownership sort of depends on the severity of the reporting. So this 5471 is filed with your 1040 every year. It has another large penalty associated with it of $10,000. And like I said, depending on how much you own, you could be reporting the balance sheet, income statement, and then if it's controlled, so if it's a controlled foreign corporation, so it's owned by more than 50% owners, then we get into the new Trump guilty tax issues. And again, this could warrant its own presentation. But it's definitely something that has been more punitive. Now there's been recent regulations that help regulate this a little bit more for small businesses. But the idea is if it's considered a controlled foreign corporation, then the US shareholder is picking up 50% or picking up their share of the income on their 1040 every year and taxed on it personally. So with the changes, we went from this deferral of tax that we used to have to basically every current year recognizing those taxes. Okay, so I'm gonna skip through a little bit more because I want to have time for our questions at the end. 8865, similar to 5471s, this is for partnerships, large penalties. Trust, I sort of talked about this before, 3520s. So this is something relating to your TFSAs that would need to be reported every year. Gift and estate tax. So this is probably one that a lot of people are concerned about or have questions on. In Canada, we don't have an estate tax. In the US, you have an estate tax. It's an but currently up until 2025, where they'll revisit, there's an $11.4 million exemption, which with splitting, if you and your spouse are both US residents, then that's doubled. So we're looking at 22.8. Really, the amount of the US citizens that are actually paying estate taxes are less than 0.03%. And those are usually what they say, those who do it's because of poor tax planning. So for those of you who are in this bucket, then usually you want to be consulting with your practitioner, evaluate how you can get out of this estate taxes. Gift tax. In Canada, we don't have gift tax. You can gift unlimited. In the US, you can only gift up to $15,000. If you are a US citizen, you can only gift $157,000 to your non-resident spouse. But you have this exemption amount. So this 11.4 million is for your estate and gift. So if we have clients, they were to gift something large, say for example, they gifted half their home to the other spouse. That was a non-resident and it was $500,000. We'd be filing a gift tax return. They wouldn't owe gift tax. They just have a gift filing obligation. If you do owe gift tax, you're looking at 20 to 40% depending on the type of gift. So it's quite a punitive tax. Surrendering green card. So this is something that I think for a lot of individuals, it affects a lot of clients if they go down to the US, they're working in the US and then they decide to come back. This is something you need to be mindful of. In order to do it, you can do it at the border or you can mail it in to the US consulate. You can go online and look up this I-407 form. The reason you want to ensure that you do surrender that if you have no intent of coming back is because, like I was discussing earlier, if you have a green card, you're still considered a US resident. So as long as you have that green card, you still have to file that tax return. And the last year, when you give up your green card, then you basically, it's similar to ceasing residency in Canada, you have a dual status return. So you'd be a resident of the US up until the day you gave up your green card. There are expatriation rules in the US. They only apply if you've been a long-term resident. So if you had that green card for 8 years of the last 15 years, then you would have this filing up, these expatriation rules. Getting into expatriation, if this is something that you are worried about, if you've had that for over 8 years, then you need to be talking to your tax practitioner because there is an exemption amount if you're a covered expatriate and your worldwide assets are under 2 million. But if they're over, there is an expatriation tax. It's a very punitive tax that you want to do tax planning to do whatever you can to get out of that covered tax, what we deem a covered expatriate. So again, something to discuss with your tax practitioner. This isn't something that you want to do willy-nilly. You definitely want to have a conversation before this is done. So I know I've jumped through a ton of things and we're almost running out of time, but we want to open it up for questions. So if anyone has any questions, please type them in to our chat here.
Awesome. So I guess we're just waiting for people to pop up. But in the meantime, there were a couple that came in a bit earlier, Kylie. So I think some of them I can actually address as well. I think you mentioned one of them was, what's the Canadian open portfolio? So just so everybody knows, like the same way that Kylie mentioned that residency really dictates a lot of the tax complication. Similarly, the securities laws in both countries are actually residency based. So an open portfolio means anything that's not a non-retirement account. So if it doesn't have an R in front of it in Canada, frankly, it's considered to be a non-retirement account, except for TFSA, which is a bit of an anomaly. So basically, you're allowed to have an open account, but it actually has to be in the same country of residency that you're in. So the laws are pretty strict on the security side, just like they are on the tax side. And I don't want to go too deep into that. But if you live in the US, your open or non-registered investments actually have to be in the same country of residence. So if you're living in the US and you left money up here in Canada, then it really either needs to be a retirement account, an education savings plan that you left for your kids, or something of that nature. Other than that, then the monies actually have to be with you in your residency, in your country of residency. Okay, another question came about asking if we were going to have access to the presentation. Yes, absolutely. We will make this available to you guys as well. There's also, we're recording the webinar as well, so we can go through that and hand that link out to you guys as well. Another one came in is, can I keep my RESP when abroad? So securities law-wise, yes, you can. As Kylie mentioned, it's a little bit of a pain from a filing standpoint, but legally speaking, you earned it and contributed to it while you were legally a resident of Canada, then absolutely the same goes for your Canadian retirement accounts. You can maintain them. You just can't add to them while you're abroad. Last question. Oh, here we go, another one here. So if you want to retire and come back to Canada, when it comes to your investments, that's one thing. When it comes to your taxes, that's a whole separate ballgame, and Kylie can talk about exit taxes or anything of that nature that may have to be done for someone coming back. But from a retirement account standpoint, it's funny. There's actually a common misconception that you have to get rid of your investments and sell everything when you move back. You actually don't have to. You just need to be either with the firm or have an advisor's license to be able to handle that. But that's a good question. So Kylie, here's a question for you. They're all flooding in here right now. What happens to TFSA for a green card holder living in the United States? Do you think you can hop on that one?
Yeah, sure. So it would be similar then for you if you were a U.S. citizen. So you'd have a 3520 filing obligation for that TFSA. The income made in that TFSA would not be tax-free in the U.S. And so for you, you would need to discuss with your tax practitioner, but basically they'd be filing a 3520, a 35 and a 3520A. So because it's considered a foreign trust by the IRS, that's why you have these trust filing obligations.
Okay, thanks, Kylie. So another question here came in as well is, I'm a Canadian citizen and I recently opened up a trading account in the US. Can you elaborate a bit more on how I would be taxed on the capital gains?
So capital gains, so if you maintain your Canadian residency, those capital gains will only be taxed on your Canadian tax return. You will not have a US filing tax return obligation for those capital gains. Capital gains are always taxed where you live.
So if I'm living in the US, for example, but as a Canadian citizen, how would that be treated? It'd be taxed on the US side, correct?
If it was in the US, yes. And if it was in Canada, it'd still be taxed in the US.
Perfect. Okay, so question with regards to dual citizenship, does residency trump my citizenship?
Yes, it does. Mm-hmm.
Perfect, that's a good question. And there's another one on somebody who was, oh, here's a new one here. If I move my in-laws, Canadian citizens, to the US to take care of them, it sounds like they must abandon their Canadian citizenship. That would remove their access to Canadian government healthcare, insurance plans, etc. Correct?
So if they'd still be getting CPP and OAS, that doesn't matter where you live. It's not residency based. OHIP, that's a different matter. So OHIP would be, you have to maintain residency to get OHIP. So that's probably a big thing that you want to consider. I know a lot of my clients, when they're getting older in age, they're wanting to maintain residency in order to maintain their OHIP.
It's a great question. It's a common one. We hear that one quite a bit as well on that front. Another one that at least I've come up with a fair amount in my practice as well is the Secure Act that's coming through and the potential changes. Can you give some high-level commentary on some of the changes that are coming down the pipeline?
Yeah, I would have to look through. I haven't really, like, a lot of it hasn't been disclosed on my end. Like, it's more with the 401ks, right, and the IRAs. As far as
that side has been, absolutely.
Yeah, like the contribution amount and the taxation of it as far as when it's taxed. Because typically, if you withdraw before 59 and a half, then you get an early withdrawal penalty, but they've changed some rules on that. I can definitely get a reg on that and have it posted if people are interested.
Yeah, that'd be great. That's a good one. And just to give you guys an idea, it hasn't been made into law. This came through with Trump in the fall. But in a nutshell, all it was is that they are changing some of the IRA stretch rules that you used to be able to put them out into perpetuity, but now they're putting a 10-year moratorium on that. So it's still good. We don't have the same applicability in Canada when you have a retirement account. You can name anybody as your beneficiary in the United States, even your neighbor, for example. In Canada, you can only really name your spouse, and then after that, it's deemed that you've liquidated your assets. But anyways, outside of that, they've changed a few things in order to change the retirement withdrawal limit. So it used to be 70 and a half years old. Now it's 72 is the new proposed age. That's how they're funding it, is by putting a little bit of a moratorium on inherited IRAs. You still can, you just have a 10-year window. Last question here, and then after that, if anything else, you can please submit them via email, and then we're happy to answer them offline as well, just to keep everybody on time here. How is residency calculated for dual citizens? Canadian resident who attends a U.S. university.
So if you're a Canadian resident attending U.S. university, you would be filing as a Canadian resident still. So again, citizenship doesn't dictate how you're taxed. So for Canadian purposes, for a U.S. citizen, oh, so they're a U.S. citizen as well? Is that what they're saying?
No, it was a Canadian. So dual citizen. Yes, correct. They're a dual citizen.
Okay, so they're a U.S. citizen, so they'd already be filing a U.S. tax return if they have a filing obligation. So typically as a student, you don't have any income, right? So you wouldn't have a U.S. tax filing obligation. The benefit of students is there's an opportunity credit, so you can get a refundable credit up to $1,000. The issue is if they don't have earned income, they're not able to get this credit, so the parents will typically take that credit. But for example, if you had a student living in the U.S., going to school in the U.S., but no a dual citizen, they wouldn't have a filing obligation in the U.S. under U.S. tax filing rules because they don't meet that income threshold. So if they weren't working and their unearned income, so their investment income was under $4,000, then they wouldn't have to file. In Canada, they're probably still going to maintain, if they're maintaining residency in Canada, they're probably still filing in Canada to still get those GST credits.
Perfect. Okay, so just sort of as a wrap up, thank you so much, Kylie and Zoe for arranging this. We really do appreciate it. You know, I know we've been getting a lot of inquiries from people to do some offline commentary, so we're offering complimentary analysis calls as a follow-up to the webinar to anybody who's really interested. If you have personal stuff that you want to go over, I can appreciate you may not want to go over that over a live call. So instead, we'll share our contact information. You can reach out to Zoe as well, and then she will definitely put us in touch. Outside of that, we really appreciate you guys taking the time to have a chat with us today and learning about this stuff. I know that we're in kind of unprecedented times. We appreciate you guys going through this, and with all COVID and everything that's going on right now, I know everyone's a little bit afraid. I would just reassure everybody just to remain as calm as possible with stuff. I mean, these things happen and they will pass in time. So every single day we get people asking about, you know, what do we think? Is it over? Is the sky falling? Probably not. It doesn't look great in the short term, but over the long run, things do stabilize over time. So don't worry too much. And we really appreciate you guys taking the time, and reach out if you have any questions. Thank you so much. Take care, and bye for now.
Thank you.